Thanks a lot, Sebastian, for this very kind invitation and kind introduction. Of course, it's a pleasure to stand here before this audience and have a chance to speak about this latest work. I am, of course, grateful to the Fields Institute for supporting me and hosting me on this Fields Research Fellowship. That has, of course, given me the opportunity to give a few talks and focus on research. Let's see. Okay. So the presentation I'm giving today is based on a couple of papers and on the PhD thesis of Holly Brennerly. I should say now my former PhD student, given that she completed a couple of months ago. And my collaborator, Gareth Peters, who this year moved to UCSB. You find here two papers. I'll be focusing mainly on the first, though towards the end I'm hoping to have enough time to tell you a little bit about how the quantile processes we've devised can be applied to pricing and the principal calculation, the premium calculation principle that is widely used in insurance. This is the overview, a short introduction. Then I'll tell you how to construct quantile processes, well, at least the class that we have. Then I'll move on to a special class of quantile processes, the so-called Tukey ones. Then I'll move to tell you how measure distortions, probability measure distortions, can be devised on the basis of quantile processes, and in particular the ones that the class that we have created. And there I am also going to show you the advantages of working with the Tukey class. And then these measures will be applied in a financial and an insurance context, where the question is, how do we, what is the impact on pricing and the calculation of premia in insurance when using the measure distortions that are induced by the quantile processes? And then I shall conclude. This is it sounds like a lot. I prepared for 1 hour to only discover that I have 45 minutes, so I'll do my best. But I understand there is dinner afterwards, and I'm going to be here also after, for a few more days. So if anyone is interested, I'm here. And of course, you can contact me anytime at this email address. So this is about mainly how to construct quantile processes. And perhaps I should begin, why quantiles? Why the effort to construct stochastic processes in continuous time that are quantile functions evolving stochastically? Of course, quantiles show up a bit everywhere. Actuarial science is, of course, full of it. Risk analysis, risk quantification. It's really hard not to get across a quantile function. In mathematical statistics, you'll find quantile functions being fundamental to the so-called L statistics. And it just goes on and on. Here we focus on a type of quantile process that is constructed as a composite map of a distribution function and a quantile function. And the whole purpose is to create a mechanism to control distortions, to control how distributions change, but from the point of view of quantile functions. So we're going to be constructing evolutions and distortions in a quantile space. Now, this is not new. You'll find this in economics, for instance, in econometrics, in statistics, but not in a continuous time stochastic setting as far as we can find. The large family that we obtain creates lots of different outputs. So it's a really big class of processes, and of particular interest to us is the dynamic and distorted measures that are induced by quantile processes. Now, there are different definitions, many different characterizations of quantile processes. In the past, you will find alpha quantile diffusions, conditional autoregressive, and so on, depending on the field that they were created and developed. So our approach, if you look around and you wonder, what is it closest related to? We think it is closest related to the work by Chen et al., Peters, Steinbrecher, and Shaw and Buckley, Dacios, and Tukey himself in 1977. Okay. I can't give you a summary of all these works, otherwise I won't be able to tell you anything about quantile processes the way we have devised them. I remind you here of the definition of a generalized inverse, which is this function here that maps from the real line to the extended real line and is defined in terms of this infimum. The reason why it's important is because we need this inverse, this f minus, to define a quantile function. Of course, this is just here to remind ourselves of what is a quantile function. So you consider a real valued random variable that has a distribution fx, where the subscript identifies the distribution of the random variable in question, which is a map from the real line to 0, 1. And then the corresponding function, quantile function of the same random variable x, is exactly given by the inverse, or the generalized inverse, that maps from 0, 1 to the extended real line. Okay. So these are exactly the objects that we will be using as part of the composite map that gives rise to the quantile process. So I move straight to the construction. Now there are two types of quantile processes we construct, and I'll begin with the random level quantile process. As the name perhaps already suggests, the quantile function is a function of quantile levels. This is the little u that takes values in 0, 1. So what's going to happen in this construction is that the argument of the quantile function is itself a stochastic process. So at each point in time, that will be a random quantity, giving the suggestion of calling this class of processes a random level quantile process. So we have a probability space, and we consider a probability space that is equipped with a filtration, unspecified. And on this probability space, we introduce a process that is adapted to this filtration ft. Then we have the first ingredient in the construction. It is a quantile function that has a parameter set we call here xi. So this might be a vector, might be more than one parameter. And zeta identifies the family of the quantile function. So if we're talking, for instance, a quantile function of a normally distributed random variable, then the quantile function will be the inverse of the normally distributed random variable. If the random variable is 0, 1 normally distributed, it will be the probit function. Then xi will, of course, not have any degrees of freedom because there won't be any parameters, given that the mean and the deviation are fixed and equal to 0, 1. So this is how we can create, of course, lots and lots of examples, or just look them up from a list of quantile functions. In addition, and this is the second ingredient in the composite map construction, we consider a distribution function, continuous, that comes with its own parameter set, theta. And this is, of course, a map from R plus to R plus cross R plus for the time variable and Y for the and R for the Y variable that maps on 0, 1. And as I said, theta, as also xi, can be a vector in the in a d-dimensional real space. Then at each time t, that is in this open set 0 and infinity, we can define what we call the random level quantile process as exactly the announced composite map. You see that the argument of the quantile function is precisely the distribution function, which itself has as an argument the stochastic process y we started off. Now, given that f is a function of a stochastic process, then f becomes a stochastic process. Q, being a function of a stochastic process, becomes a stochastic process. And of course, what it means is that Z is a stochastic process itself. But Z is a quantile function. So at each point in time, the stochastic process, right, for every realization of a sample point in the sample space for the stochastic process Y will actually be a quantile function for a specific quantile level. And this is explained here in this map. So if a yt is ft measurable, then zt will be, of course, also ft measurable. So there are different cases that arise. So the first case is when the distribution function f is actually the distribution function of the driving process y. In that case, if we are in a finite dimensional setting, we see that the distribution function of y applied onto y will yield a uniformly distributed process u sub t. But this is only the case when the distribution function happens to be exactly the one of the driving process. Now, in reality, if you think of applications, that might be not the case, because you don't actually know what the distribution function is. Yes, Ivana? Please.
Do you consider univariate processes?
In this, here, yes, absolutely. Here it is completely univariate. For this talk, I'm not going to go into multivariate, but in the paper, we have actually a section on multivariate extension. It becomes a bit trickier, and I think this is why you're asking the question, because then it depends how you're going to be mapping the multidimensionality or multivariate system. We present some ideas there, but of course, you will have to pay much more attention. Thanks for the important question. Then the first proposition that one can prove is that the quantile process Z has Cadillac paths if and only if the map from T to the distribution function ft is Cadillac and the quantile function or quantile family is continuous. The parameters xi and theta here are suggested to be constant, but in reality they can be time dependent. They could in principle also be stochastic. But we proceed in stages instead of going full on generality. Right. So one motivation for us at the beginning was actually a very simple question. Suppose you have a stochastic process y, and it doesn't present any skewness and kurtosis, for instance. But you'd like to consider a transformation that allows you to induce skewness and kurtosis, but in such a way that it's fully controlled, meaning that the level of skewness and kurtosis built into transformation can be fully controlled by specific parameters, so that it's fully interpretable and can be controlled in a one-to-one way. So if, for instance, skewness and kurtosis is the objective, and one wants to understand how much more skewness or how much skewness is actually introduced, and the same for kurtosis, then we have this beautiful paper by Tzvet in 1964 that tells us how to order the various levels. And this is where quantiles are particularly important, and quantile functions and extensions as we consider them. I'll come later to this, but this was just the first motivation for us, how to implement skewness and kurtosis, if that is the goal. Then there are ways that you want to do it, and these ways may be relative to certain notions of centrality. And centrality could be a mean, it could be a median, it could be another measure, a mode, for instance. And because we're dealing with composite maps, any transformation will be given in relative to some base distribution. So here, if you're starting off with a process y, which will have its own law, whether known or not, it will of course have one, then it will be interesting to always understand how the distribution is transformed by applying the quantile composite map relative to the base distribution that the process Y came with. So this is where Tswet's work becomes interesting. Here is one characterization that is very important. So the first question is, can you apply any sort of composite map, and are you always going to be happy? Well, it would be nice to have something that tells us that the transformation that you're going to be applying will preserve the property of a quantile function. So here, if the map R to R is quantile preserving, then what it means is that if the map is applied on a quantile function, then the result will be, again, a quantile function. Now, there are examples of this kind of transformation. So we have the Q transformations that you can read in the book by Gilchrist, rank transformations as considered by Shaw and Buckley in 2007-2009, elongation and reshapes, the ones that we are going to look at in more detail, proposed by Tukey in 1977 and Hoagland in 1985. And I'm sure that there are many other cases that can be constructed. These are the ones that we considered. Now, it might look like as a simple thing, this composite map, this quantile process. But how about we look at actually how the quantile process evolves and how it is actually constructed if you had to actually code it. So here is the interpretation of a random level quantile process. What we have is, say, a quantile function. So that's the Q zeta. You can't read it, but you'll have to believe me that what I'm drawing here at different times is a quantile function that might be actually itself time dependent. And the blue dot, the red dot, and the green dots are the quantile levels at different times. Okay. Now, because the argument of our quantile process, U, is a stochastic process, given that it is a distribution function that is driven by a stochastic process Y, of course, the argument of the quantile function is a stochastic process. And so at T1, it may, the blue path may go through this value here, and then at T2 it through this value, and at T3 this value. But in reality, in continuous time, at every point in time, this U process will will realize a quantile level. And so also for the red path and for the green path. Okay, this is to showcase, to illustrate the dynamics and meaning of this process U that is the argument of our quantile function Q zeta. So having this process U, we now can plot or illustrate what the quantile process is, which is this depiction. So the three paths are exactly the U process, but now you see that if you have the quantile function depicted here with the line, the blue line, that then over time might evolve to this blue line and then later to this blue line, the process U and each path of this process U will at each point in time select the quantile level. Okay, so what you actually have when you simulate the quantile process at each point in time for every selection of little omega, which is the sample point in sample space, that will yield a quantile value. Okay. So this should make it more accessible to understand that the Z, our quantile process, is indeed a stochastic process, and it's indeed a quantile because all values it takes at each point in time for every realization of the argument for each sample point will yield a quantile value. Not to be confused with the quantile level, which is the process capital U. I mentioned that this is one construction, so we have another construction which we call function-valued quantile process. So this is closest related to models presented in the paper by Chen and al. But this paper here is in discrete time, so we extend it to the continuous time setting. So in this case, again, we have our quantile function as before, but now what we're going to do is consider the parameter set, so all quantile parameters being themselves stochastic processes. Okay, so the quantile level little u is not a stochastic process like before, but it's the parameters that evolve in a stochastic fashion. So now the parameter processes might be a d-dimensional, they might be they are FT adapted and have dimension d and have CAD-like paths. And so the construction of the function valued quantile process is in a sense much easier, because all we have to do is take our favorite family of quantile functions qz and randomize, evolve the parameters of the specific family as a stochastic process. So this equality, unlike before when it was in distribution, is actually 1 omega by omega, because of course it is dependent on the realizations of this process here. But what is interesting about this construction is that for every realization of the stochastic process at each time t, what we get is of course a quantile function, and this is why we call this a function valued construction. So if we depict now this type, then what we have at the bottom is the quantile function, the family that we might want to consider, and at time t1, having the parameters realized values, say 2.1 and 0.9 here for the sake of the illustration, takes this shape. Okay, but then a little time later, or a long time later, the parameters will have changed, and the quantile function as a result will have changed, and so on in time. Okay, so what happens is that as the stochastic process of the parameters evolves, you always get at each point in time a whole quantile function. So the quantile function evolves stochastically due to the stochastic parameters, and at each point in time one obtains a whole quantile function over all quantile levels from 0 to 1. Let me move to the Tukey class. I didn't check when I started. I hope you did, Sebastian. Okay. 20. Okay, then I have to move really fast. So, so we have here the Tukey random level quantile process. So this is now identifying basically the zeta. Okay, so we had Q of zeta. Zeta was the family of quantile functions. So we identified that zeta with the Tukey class. Why Tukey? Because the Tukey transformation produces an produces a elongation. So the distortion of the process is produced by an elongation and reshaping. Okay, and these two definitions tell us how the elongation is produced and how the reshaping is produced. And there are, of course, conditions, because all you want is to be able to relate always to the base distribution. So the elongation and reshaping should be relative to the base and relative to, say, exactly a notion of centrality, for instance. And this is what these two definitions do. The reshape transformation is important because it tells you how much skewness, positive skewness or negative skewness is obtained by the transformation, okay? Or how much kurtosis is added by the Tukey transformation. So in particular, if the reshape transformation is convex, then the base distribution is skewed to the right, so you have positive skewness. If the reshape transformation is concave, then you're going to have skewness to the left, and so on and so on. So you get the gist here of how the quantile function affects the distribution you started off with. So the Tukey function or Tukey transformation is defined as in equation 4, where Tx is exactly the transformation function that we had earlier, or the Tukey function that we had earlier. And what is important about this transformation is that the result is a quantile function. Is a function, so is a random variable that is Tukey distributed with quantile function given as exactly transformation of the quantile function of the base random variable, the random variable we started off with. So it is a quantile preserving map, right? And has this characterization that the distribution of the resulting random variable, the Tukey random variable, is identified through a quantile function. So what is it good for? There are many parameters, but the two most important ones, if you want to build in skewness and kurtosis, are called Tukey G and Tukey H. G is the skewness parameter, H is the kurtosis parameter, and of course you can create distortions that change skewness and kurtosis at the same time. And these transformations are usually relative to a normally distributed random variable, because of course we know that the normally distributed random variable doesn't have skewness and kurtosis, so you exactly know how much skewness and kurtosis is implemented by this transformation. Here are the three functions I've been talking about. So if you want to create skewness relative to a normally distributed random variable, 0, 1 random variable, for which the quantile function is this one here, the probit function, then this is the Tukey G transformation, where G controls how much skewness you induce. The same for the Tukey H, but this H is the way kurtosis is induced. And then the composite, or the composition of the two, a function in its own right, a quantile function in its own right, QT-GH, where this transformation will induce skewness and kurtosis, always relative to a 0, 1 normally distributed random variable. So these are a few plots that show you exactly the effects of the G parameter and H parameter for skewness and kurtosis. I'm not going to go into details here, but it's always relative to the normally distributed random variable, standard normally distributed random variable, 0, 1. And these are various degrees of kurtosis that you can add and various degrees of skewness that you can add. Right, so if you wondered what is the Tukey GH quantile process, then this is the one, equation 5, where the distribution function f may not be necessarily the one that is the law of the driving process y. And you can see that here you have lots of freedom. You could, of course, create lots of different processes through this transformation. There will always be Tukey quantile processes, but the degrees of freedom, of course, lie in the law of y and then the law in the distribution function that you consider for f. So a few examples of Tukey quantile process. So you can create what we call the skewed Brownian motion quantile process, which will use a distribution function that is actually the distribution of Brownian motion W. You can create the leptokurtic Brownian motion quantile process that use a Tukey H transformation, again, wherein you use the distribution function of the Brownian motion. And then, you know, really, the fantasy is the limit. You can choose a different driving process, a different distribution function, the composite map, and so on and so forth. So this leads me to measure distortions. So here, the bottom line is, how can we use quantile processes to induce specific probability measure transformations, probability measures? Now, the appeal by doing it on quantile processes, if I take the example of the Tukey quantile process, is the following. If a Tukey quantile process creates skewness and kurtosis, either or both at the same time, then if we were to devise a new probability measure on the basis of the law of the quantile process, then the new measure would incorporate exactly the skewness and kurtosis that is controlled by the parameters of the inducing quantile process. Okay, so this is the idea here. And why would that be interesting? Because if you do pricing, for instance, or you want to calculate premia according to some risk, and you think that the risk is presented by this Y process that has been here in the background, but you think you should be more conservative, or you want to actually find out how the pricing changes if skewness is introduced, or kurtosis is introduced, or both is introduced, then what you're actually looking after, what you're looking for is a probability measure, to create a probability measure that will precisely include the transformation that gives rise to the skewness and kurtosis under the new measure. So this is what we obtain here. And other ways of creating distortions are, of course, Wang transforms, and a recent paper by Godin. We have the Escher transforms, and many other types of tilting and weighting. There is this interesting paper by Fuhrman and Zitikis, where the kind of transformation, probability transformations are of a functional type. And by the way, using a quantile function as well. So I'm going to present here our approach. So what we do is, once the quantile process is created, the process will induce a measurable function z from the sample space to the space D, where we have these paths. And the law of the quantile process is defined to be the push-forward measure that we call Pz, that is exactly the distribution that arises from the law of the quantile process itself. Okay? And then you start entering the realms of Radon-Nikodym probability measure changes. And all I write here is the mechanism by which, under the new measure, the distribution of the random variable is changed. And if we are dealing with a finite dimensional distributions of the quantile process, then the result of this measured distortion will be that the distortion of the distribution will be marginally. So every marginal of the process will change according to equation 9. You can do it, of course, conditional on the filtration that is at play, to which the process is adapted, Z and Y. So this is all standard machinery, but applied in the setting of the quantile processes. Right, so what one creates is this mechanism to change measure from some probability measure P, which could be the real world probability, to the probability measure Pz that encapsulates the transformation that is effected by the quantile process itself. Okay. Now, why is this exciting? Maybe when we think of a measure change, we are, just because it's always so famous, especially in financial mathematics, we think of a Girsanov transformation. Perhaps that's the first thought that we have in our minds. But the Girsanov transformations change the drift of the process, right? But this kind of transformations here, measure transformations, may affect other moments. So in particular, if the quantile process adds or changes the skewness and kurtosis, then Pz and the Radon-Nikodym derivative between P and Pz under certain conditions that I don't have the time here to discuss will precisely include distributional changes to do with skewness and kurtosis. Okay, so it won't be a Girsanov transformation. Okay, and this is the appeal. But of course, in general, you don't know how skewness and kurtosis is implemented. It can be, many parameters at play. There's no understanding what parameters you're going to be changing in order to control the skewness and kurtosis. If you're dealing with two key quantile processes, and Z is such a process, and Pz is exactly the measure that has been created on the basis of a Tukey quantile process, then PZ will tilt or change the distribution under the measure PZ to do with exactly the level of skewness and kurtosis that has been changed in line with the parameter G and H in the Tukey transformation. So it's a little bit like in Girsanov, right? So if you have a parameter that controls the drift that you're adding, then you know exactly how much drift that you do. But for higher order moments, that might not be that easy. With Tukey, it is. So here are examples for different levels of skewness and kurtosis. The straight line, the 45-degree straight line would be if no distortion is affected. And here we have a similar case when the underlying process Y has actually a drift. So I think here we used just Brownian motion, standard Brownian motion plus drift, where the drift was just constant parameter mu. Okay? So it just moves up and down, of course, the transformation. Right, so let's see if, yes, I think I can summarize this slide for you in a couple of sentences, given that we're heading towards 7 o'clock already. So where could these measure transformations be particularly important? All these measures that you might be creating are to be seen as subjective measures, right? So if we take our example of an insurer or a risk assessor, then they will all have their own opinion as to how much skewness should be considered, for instance, or how much kurtosis should be considered relative to some distribution. So all this quantile process in reality will give you subjective probability measures PZ in line with the transformation that is devised. Where is such a situation typically encountered? I'm thinking, for instance, of climate risk. We had a wonderful conference last week dedicated to climate risk and climate finance and insurance. There isn't a market that tells you what the risk quantification is and how it should be priced. You might be dealing on the basis of scenarios. Those will be subjective given what has been the agreed context. But then somebody else comes and says, actually, I believe that the future is not going to be the path that you are telling me about. It's not going to be just a 1.5 degree global warming, but it's going to be more a 2.7. Somebody says 3. Well, this is, of course, essentially discussing what the distribution should be under certain effects. Right? So there could be a PZ for each government, for instance, who needs to make a decision as to what policies to implement. So this takes me straight to the pricing and valuation on the basis of distorted probability measures as affected by quantile processes. So we have a definition telling us what a stochastic valuation principle is that really tells us that there is this what's the word I'm looking for? Contraction, thank you, across time. Perhaps if one sees this, one thinks immediately of the conditional expectation, and this being essentially telling us that it's the Tower property of conditional expectation. It is, in fact, what we will consider because it has all sorts of beautiful properties like time consistency, for instance. And also because a lot of the evaluations are now going to be done or are done under conditional expectations. Now, this gives me the opportunity to tell you about something else. So you might have heard about other potential risk measures or other ways, operators in order to arrive at the pricing principle. And you might have heard of nonlinear expectations, right? Where nonlinear expectations, one of the things that they do is precisely tilt distributions, deform distributions by considering a function on an underlier. Here, although we haven't researched this link yet, the operator is linear, it's just the expectation as I'm going to show. Maybe it's already, yes, it is on the next slide. But the deformation of the distribution is produced exactly by the quantile process and the measure under which we're going to be using the conditional expectation, which is going to be the PZ. So when you look at the pricing operators, one thing that is important is to have a dynamical consistency with risk loading. What is risk loading? Risk loading is how much more premium, essentially, are you going to be asking if the risk in some way is regarded as riskier. Let me give you a better way of explaining it. Suppose the risk is normal distributed, standard normal distributed. That is perceived as not being particularly risky, right? Why? Because it doesn't have skewness and kurtosis. But now we have a way of implementing skewness and kurtosis, among other moments, if we want it. So the question is now, how is the premium going to change given that the risk exposes me to skewness and kurtosis? And what is important for pricing and the calculation of premia is the notion of dynamical consistency that is specified here, that tells us that the pricing principle should be greater or equal than the actual expectation, which does not is not affected by a distortion of the actual risk process, that here is the Y. Okay? And then we have a statement that tells us that if our Y process is FT adapted and the pricing principle is given by conditional expectation, where P tilde might be the probability measure that includes a distortion, then if P tilde is such that the that the conditional probability is greater or equal to the probability under the real world measure, so the not distorted, for instance, then the pricing principle produces a dynamic and consistent risk loading. So if we want to satisfy the definition here of consistent risk loading, then all we have to do is to check whether the PZs that we are devising satisfy this relationship. And in short, the answer is affirmative. So there can be measures PZ can be created in such a way that relative to pricing under the real world measure P, where no distortion has been applied, will actually yield a value that is greater or equal to the non-distorted pricing. And then we have various propositions that rely on checking whether the distortions obey what's called the first order stochastic dominance or a second order stochastic dominance. And unfortunately, I don't have the time to tell you much about this. This is what is mainly dedicated, the second paper is dedicated to. When you deal with quantile processes, exactly the requirement of creating first order stochastic dominance or second order stochastic dominance is particularly amenable, because the quantile process, of course, are monotonic increasing functions, and that gives us the almost for free, and it's not for free, I mean, you have to work a little bit, but that will give us the basis to prove that the quantile processes will actually have a good chance to satisfy these dominance relations, which then in turn will be applied to show that the pricing principle under the quantile induced distortions will obey consistency for risk loading. And I think I'll just, am I right that I should wrap up? Yes. So I'll just finish with this slide then, and tell you that although I've just touched on the notion of pricing under measured distortions, this notion of risk analysis and how distributions associated with risk can be modulated is not only important in finance or in insurance, but it could be, for instance, important in assessing what the damages are due to a catastrophic event. So imagine somebody needs to make provisions as to, I don't know, how many people will need shelter after a catastrophic event, after a hurricane. Are we going to prepare for 100,000 people? Are we going to prepare for 1 million people? So these kind of analysis are also important in other places other than finance and insurance. And I think I'll stop here, and thank you all.